Albert Einstein famously called compound interest the eighth wonder of the world. He understood a mathematical reality that most retail traders completely miss. If you start with $1,000 and manage to grow it by 10% every month for 5 years, you don't end up with $7,000. Because of the mechanics of compounding, your final balance would sit at over $300,000. Yet, despite this extreme difference in outcomes, the vast majority of retail Forex traders treat their accounts like a linear ATM. They fall into a trap of fixed sizing. A trader decides they will risk exactly 0.1 lots on every single trade, locking themselves into an unchanging volume until they arbitrarily feel ready to size up. This approach caps your upward momentum entirely. When your volume stays perfectly flat, your account grows in a straight, slow line, leaving your capital highly vulnerable to normal market turbulence. The truth is, the specific mathematical mechanism you use to size your positions determines your long-term success far more heavily than your technical entry signals. To build significant capital from a small starting balance, you have to leave your linear comfort zone behind and adopt the geometric engine that professionals use: fixed fractional position sizing. Fixed fractional position sizing is a strict rule. Instead of risking a static lot amount, you risk a consistent percentage of your current equity on every single trade. In this comparative chart, two hypothetical traders start with $10,000, achieving a 60% win rate over 50 trades. Trader A risks a fixed 0.5 lots, steadily doubling their account to $20,000. Trader B recalculates risk to 2% per trade, creating an exponential compounding curve. This creates what statisticians call a geometric mean effect. During a winning streak, the fractional sizing causes the account balance to hyper-accelerate, pushing the total returns far past Trader A. In a professional scaling model, your volume is dictated by your growth. The math scales your exposure automatically. But that exact same math highlights a brutal reality of trading. Compounding cuts both ways, and you have to account for drawdown asymmetry. Losses and gains are mathematically unequal. A 10% drop requires an 11.1% gain to break even. The deeper the loss, the steeper the curve. A 50% drawdown demands a massive 100% gain just to restore your starting capital. This leads to every trader's uncle point, usually around a 20 to 25% drawdown threshold. Cross this line, and the math required to recover becomes so statistically improbable that your compounding engine effectively stalls out. Aggressive geometric gains are useless if you don't cap your downside risk. Without a strict fractional safety valve, a deep drawdown becomes a mathematical trap you simply cannot trade your way out of. Even with perfect sizing, small accounts face an invisible enemy: friction. Market spreads and flat broker commissions act as negative compounding agents, eating away at your equity. This creates the small account trap. If you have a $500 balance, a standard $7 commission creates a massive proportional drag on your capital. A sizable chunk of your account is simply gone the moment you click buy. To outrun this friction and grow safely, you need tiered compounding, a strategy built on anti-martingale logic, where you only increase your exposure when the market is proving you right. In Tier 1, protect your seed capital by risking a tiny amount until a profit milestone is reached. Once in the green, unlock Tier 2, scaling trade sizes aggressively using only accrued house money. Sustainable scaling relies entirely on this shift. You secure your initial deposit early and then place the burden of risk squarely on the market's money. The math of risking 2% is perfectly logical on paper, but as your account grows, you will inevitably hit the cognitive scaling gap. A 2% risk on a $1,000 account is just $20. You can lose that and sleep soundly. But apply that exact same 2% math to a $100,000 account, and suddenly you are risking a highly stressful $2,000 per trade. Biologically, nothing changed with your strategy, but your brain registers the absolute dollar amount as a threat. This physical stress triggers hesitation and causes traders to prematurely lock in profits. You have to desensitize yourself. Start by changing your trading terminal settings to display your profit and loss strictly as percentages or risk units. Remove the absolute currency values from your screen entirely. Next, use the 10% step-up rule. Every time you hit a major equity milestone, deliberately drop your trade size by half for 3 days. Let your brain normalize the new numbers before you return to full compounding. Long-term success requires getting out of your own way and letting the geometric engine work. Stop thinking in pips, start thinking in percentages, and download the FXNX position sizing calculator to automate your growth today.